Hello everyone, this video is an analysis of the Great Depression in 1929. The Great Depression is generally defined as a severe global economic recession that started on the 29th of October 1929. That was a few days after the US Black Tuesday stock market crash. The Great Depression originated in the United States and spread to Europe and finally to the rest of the world quickly. It caused serious deflation, poverty, unemployment and other problems. It had lasted for about 10 years and was considered one of the worst periods of the world's economy. And here, we will further talk about the causes, consequences, and the similarity with the 2008 credit crisis. One of the major causes of the Great Depression is the stock market crash that occurred on Black Tuesday, 24th of October 1929. In fact, it was one of the most devastating stock market crashes in the United States history. And on that day, the market lost 11% of its total value at the opening bell. This stock market crash was simply due to the over-leveraged and overheated speculation in the late 1920s. In just 2 months, stockholders had lost more than $40 billion. After that, the stock market had a very short period of recovery by the end of 1930. However, it was definitely not sufficient to recover the huge loss. As a result, people had their purchasing power sharply declined and lost their confidence in the market and the economy. This marked the beginning of the Great Depression that lasted for 10 years. Another cause is about bank failures. As mentioned above, the sudden decline of the stock market had led to a public panic. As a result, hundreds of thousands of people began to withdraw their deposit. Due to the sudden withdrawal of a huge amount of savings, many banks did not have sufficient capital to finance their operation and failed. By 1933, over 40%, that is about 11,000 banks in the United States, had disappeared. At that time, bank deposits were generally uninsured, and people simply lost their savings as a result of the bank failures. As for the remaining surviving banks, because they were unsure of the future economic and financial situations, most of them stopped creating new loans in order to prevent further risk and ensure their survivals. This led to less expenditures in the nation and ultimately the Great Depression.
The serious impact of Great Depression is partially caused by American self-protective economic policy. When the business began to fall, American government introduced Smooth-Haley tariff, which is an around 15% tax of import. It aimed at protecting the local goods, but reduced the trade occurred between US and foreign countries as a consequence. Foreign countries, including Canada, who is America's greatest trading partner, retaliate the US economy by imposing new tariffs to the US goods and boycott US export. America suffered from its own medicine as a result. According to microeconomic theories, trading encourages better usage of resources and it is one of the best ways to improve economic conditions. Tariffs affect trade, misallocate resources, and raises the price level indirectly, which harmed the economy and contributed to the occurrence of the Great Depression. Another cause of the Great Depression is the huge drop in consumer spending. Since the stock market crash and the fear of further economic woes, consumer purchasing power and willingness to purchase decreased. It led to a vicious cycle that worsened the economic environment. At the beginning, individuals purchased fewer items. The low demand of goods led to accumulation of inventories and reduced income of companies. Companies cut losses by reducing the number of products produced and cut the number of workforce. The unemployment rate rose to above 20% during the Depression. And the unemployment situation further reduced the spending in the US. The cycle reinforced itself and worsened the economic situation. The drop in consumer spending caused a limited money supply in the market. It explained why the economy failed to recover from the Depression and the serious consequence after the outbreak of the crisis.
Now we may like to talk about the consequences of Great Depression. To start with the business sector, especially in agricultural sector, there were more than 32,000 businesses went bankrupt. Furthermore, because of lack of subsidies and loans from government and bank, farmers were unable to do mass production and cost output decreased. To illustrate, there were a great drop in price of agricultural products from 1929 to 1932. This consumer price index reflects a big deflation after Great Depression. The deflation led to a drop in investment and consumption, which caused a drop in GDP. From the graph, we can see that the GDP of the US reduces 30% from 1929 to 1933, and most of the countries also suffered a decrease in nominal GDP. In addition, unemployment rate in the US increased to 25%, as firms and banks cut costs by layoff labor. These impacts even influenced other countries. Since price level of US dropped, other countries imported more the US product. This caused the local production of other countries decrease and unemployment happened. Apart from the above impacts, per capita income in most countries also dropped a lot after Great Depression. For instance, the US dropped 37.5% and Germany decreased 25%. Another huge change after Great Depression was the abolishment of gold standard in many countries and changed it into exchange rate system. For example, the UK, Germany, and Japan. This was because countries want to stimulate their economy by publishing monetary policy. However, this led to currency war and a further global economic depression. Finally, this was the impact on international trade. We can see that there was a great decline in both world production and trade. This was contributed by protectionism in countries. From the statistics, lots of countries, such as Germany and Switzerland, doubled their tariff. This kind of beggar-thief neighbor trade led to loss of competitive advantages and misallocation of resources.
Moreover, there are also several political consequences after the Great Depression. First of all, it is the rise to militarist governments. In countries such as Germany and Japan, reaction to the Depression brought about the rise to power of militarist governments who adopted the aggressive foreign policies that led to the Second World War. It is because they want to get more resources from other countries. And another consequence is the setting up of welfare systems. In the United States, the government intervened to reduce unemployment by work creation schemes such as painting of post offices and street cleaning. And the last consequence is the agriculture and industry were supported by policies to control the output and increase the prices by the government. In addition, there are several social and cultural consequences. From the social aspect, there is increased crime rate. At that time, masses' faith over the economic system shattered. Theft, burglary, and felony became common occurrences. Moreover, with no income and several mouths to feed, workers were pushed to commit suicides, and they suffered from malnutrition due to the lack of income. Also, one of the consequences is a mass migration. Many people relocate to other countries in search of better employment opportunities and increased standard of living. Many of them moved to the California or the Arizona, and this leads to the cultural diversities we witness today. From the academic aspects, there are also several consequences. One of the consequences is the contraction of students' bodies. It is because higher education was beyond anyone's reach, and due to the lack of public spending, many schools were closed down or understaffed. However, there are also several positive outcomes after the Great Depression. That is, the emergence of concepts of labor unions and welfare states. They brought the trend of collective bargaining to voice the concerns of the labor distress, which is a well-defined form of communication in companies today. And in the United States, union membership doubled in its size from the 1930s to 1940s.
Now let's march into the similarities between Great Depression and 2008 crisis. The first similarity is that the causes of two crises are both attributable to the burst of US market as the strongest economic power in the world, both in 1920s and 2008. Because of the close economic ties between US and the rest of the world in terms of international trade and foreign capital investment, domino effects are observed which triggered the economic recession in the globe. In the days of Great Depression, Since consumption and investments fell in US after the downfall, export-driven countries relying on US market have suffered a huge loss. For instance, agricultural production and industrial exports in Canada and Europe have dropped sharply. That's all? No. The American loans for post-World War I reconstruction has also stopped. The globe was again crying in despair, whereas in the 2008 crisis, owing to the interdependent financial market, the profitable prospect in the pre-2008 periods has pulled in mortgage securities in the global financial market. Similarly, all suffer together in the crisis. Reduced consumption and investments in the global scale are observed. But one might ask, apart from the US factor, what exactly caused the two crises? In fact, financial innovation significantly contributed to both of the crises, and this is the second similarity. It refers to the emergence of complicated and risky financial products. Regulatory mechanisms cannot adequately and timely monitor these derivatives and monetary products. In the Great Depression, installment consumption becomes the popular mode of transaction, yet it may add burden to the lenders and increase risk of default. How about the 2008 crisis? At that time, the financial tools are more complex and diverse, which tied more parties together. Rating agencies are criticized as inaccurate, which allowed the economic units to undermine the decisions. The booming invention of derivatives, such as the CDOs, have remained as an unregulated tools in the market where little compliance were effective in place.
Of course, the financial innovation itself is not enough. The very reason that explains both the crises is actually the speculation in market. This is the third similarity. In the 1920s, technological advancement has developed in a remarkable pace where more and more luxury goods and consumer goods are available in market. Under the booming economy, the Americans have no reason not to buy. They have so many goods and ads everywhere which stimulates consumption. They are told, what is in your hand is the strongest currency. And you don't have money yet. You can pay in installment. But this, of course, is not eternity. One day, the goods are found overvalued. They have no reasons to keep buying. The market, therefore, collapses. Again, in the 2008 credit crisis, the continuous growth in property market is telling the consumer the same thing. What's in your hand is the strongest currency. And you don't have money yet? Fine, you can borrow. The banks are happy enough as they can anyway sell your property if you cannot repay the mortgage. Leverage followed. But all they forget is that the property market is not ever rising. Overlending and rapid investment has led to the point that they forgot all about the risk. When it all burst and the price tumbled, they all lose. The fourth similarity is that the banking sector experienced a liquidity crisis both during the Great Depression and the 2008 crisis, yet it emerged in different forms. The former was caused by insufficient reserve, whereas the latter is caused by over-leverage. Before the Great Depression, small banks were allowed to set up with low reserve requirement. As the stock market crashed, and depositors of the general public started to withdraw money out of market panic, banks fell short of reserves and resulted in bank runs. In 1933, about 11,000 small banks collapsed. The situation is somehow different in 2008, where commercial and investment banks engaged in higher leveraged investments in the mortgage market. iBanks, like the Lehman Brothers, were unable to sell the mortgage assets after the burst of the housing bubble, thus failed to pay off the debts to the large lenders and investors. In other words, although the banking sector encountered the liquidity crisis during 1920s and 2008, they are of different nature. In conclusion, both the Great Depression and the 2008 crisis offer useful insights in understanding how a financial crisis may take place. We observe that both failures share similar causes, and it worth reflection why we repeated the wrongs and how we can achieve better. We hope that you like this video.